Stop everything. If you hold silver, physical coins, bars, mining equities, even just the idea that silver is your insurance, you need to watch this now, because what is happening is not random price action. It is not volatility. It is not a meme trade. It is the predictable outcome of a repeatable machine, a machine that civilizations keep building the same way, with the same parts, until the same moment arrives. The paper layer loses authority over the physical layer. Here is the claim that sounds extreme until you see the structure underneath it. Silver isn't being bid up. Silver is being reclassified by the system itself, from a sleepy commodity into a stress sensor for monetary credibility. And when that reclassification happens, the move is not gradual. It is discontinuous. It gaps. It jumps. It breaks the models. Because silver is where the promises collide with the inventory. Authority check. The world is sitting on north of $300 trillion in total debt when you combine governments, corporations, and households. Central banks have spent a decade proving they will manufacture currency units faster than societies can manufacture real goods. Meanwhile, the last decade has delivered multiple once-in-a-generation crises. Debt shocks, supply shocks, war shocks, energy shocks, stacked back to back. That is not bad luck. That is what a saturated system looks like when it has no slack left. And the inevitability statement is simple. When debt and promises expand faster than the real economy's ability to deliver energy, materials, and food, the system must choose. It can either default honestly, admit the promises can't be kept, or it can default dishonestly, pay in cheaper units. Historically, modernly, politically, the system chooses dishonest default first, always. And once that choice is made, the paper claims multiply. The physical constraints don't. At some point, those two lines cross, and the market stops pricing silver and starts pricing the credibility of the entire promise stack. That's the machine. And the machine has stages. You can disagree with the actors, the headlines, the narratives, but you cannot escape the stages. Stage one is the setup, foundation. A society builds trust. It establishes a monetary anchor, sometimes explicit, sometimes cultural. It creates a unit of account that people believe will hold meaning tomorrow. Trade expands. Credit expands. Institutions gain legitimacy. Money feels boring, which is exactly what trust feels like. Stage two is expansion through debasement, overextension. The benefits of trust are harvested and then overharvested. Wars, welfare promises, prestige projects, political cycles, and financial engineering all demand funding. If taxes are unpopular, an honest default is unthinkable. Rulers and central authorities reach for the hidden lever, dilute the unit. Sometimes that's literal debasement. Sometimes it's paper notes. Sometimes it's bank credit. Sometimes it's quantitative easing. The mechanism changes. The logic doesn't. The claims grow faster than the underlying base. Stage three is crisis, loss of control. The system runs into reality. Resource scarcity, war, external shocks, demographic strain, declining productivity, or simply the arithmetic of compounding promises. Confidence becomes fragile. Authorities attempt to maintain control with price management, moral suasion, capital controls, censorship, emergency powers, new facilities, new acronyms. The system becomes louder because it is weaker. This is also where paper markets grow most aggressively, because paper is how you simulate supply and delay recognition. Stage four is the inevitable outcome. The physical layer asserts itself. People demand delivery, not settlement. They demand hard goods, not narratives. The unit is repriced, the anchor shifts, and the public learns, again, that money is a claim, and claims are only as good as the issuer's capacity to deliver. Now, let's prove it 3 times, in 3 different eras, with different flags and different elites, yet the same machine. First case study, Rome, the empire that mastered administration and then tried to out-administrate arithmetic. Stage 1, the setup. Rome's early and middle imperial period relied on relatively reliable coinage and expanding trade across the Mediterranean. Military dominance secured routes, taxes and tribute flowed. The denarius functioned as a trusted unit. Trust wasn't perfect, but it was stable enough to build an empire-wide economy. Stage 2, expansion and debasement. The costs of empire grew. Standing armies, frontier defenses, political bribery, grain distributions, civil wars. Emperors discovered a dangerous trick: reduce the precious metal content of the coin while keeping the face value. Under Nero, the denarius was reduced in weight and fineness. Later emperors continued, accelerating through the 2nd and 3rd centuries. By the time of Caracalla and the introduction of the Antoninianus in the early 3rd century, Rome was effectively stretching a fixed physical base across a rapidly growing claim structure. It was monetary alchemy: more coins, less silver, same value by decree. Stage 3, crisis and loss of control. As debasement compounded, prices rose, soldiers demanded higher pay, and taxpayers fled into barter and local exchange. The empire faced repeated civil wars, external invasions, plague shocks, and collapsing trade networks. Authorities tried wage and price controls, most famously under Diocletian's edict on maximum prices in 301 CE, attempting to command reality back into compliance. It failed because you cannot legislate trust. The more you shout, "This coin is money," the more the public hears, "This coin is not money." Stage 4, inevitable outcome. The monetary system re-anchored through reform and coercion. Gold solidity gained prominence later as a more stable store. While everyday exchange increasingly relied on kind, barter, and localized arrangements, the key point isn't the details of Roman numismatics. The key point is the mechanism. Overextension led to dilution, dilution triggered crisis, crisis triggered controls, and controls couldn't stop the physical layer from repricing the claim. Second case study, Weimar Germany, where the paper layer tried to overwrite the physical layer in real time. Stage 1, setup. Pre-World War I. Germany had a credible industrial base and a gold-linked monetary order consistent with the era's standards. Institutions functioned. Savings had meaning, contracts were trusted. Stage 2, expansion and overextension. World War I was financed heavily through debt and monetary expansion rather than immediate taxation. After the war, the Treaty of Versailles, 1919, imposed reparations obligations on Germany. Politically, raising taxes was explosive. Economically, paying in scarce foreign currency was brutal. The solution, predictably, was to print. The claim stack expanded while the productive base was damaged by war, social turmoil, and political fragmentation. Stage 3, crisis and loss of control. The breakpoint arrived when external pressure met internal fragility. In 1923, following reparation disputes, French and Belgian forces occupied the Ruhr. Germany responded with passive resistance, and the government financed striking workers by printing more money. Production fell, currency issuance soared, confidence collapsed into a feedback loop. Prices rose because money was printed, and money was printed because prices rose. Authorities attempted reforms, proclamations, and ad hoc measures. But when the unit itself is melting, every policy is too slow. Stage 4, inevitable outcome. The unit was reset. The Rentenmark was introduced in late 1923, tied to land and industrial assets, and later stabilized into the Reichsmark. Again, the moral is not Germany was bad. The moral is that when obligations exceed capacity, the unit is sacrificed, and real assets become the refuge. In that environment, the physical layer, gold, silver, hard goods, does not rise because it changes. It rises because the measuring stick breaks. Third case study, the United States from the late 1960s through 1980, the modern template for what happens when a global reserve system reaches its limit. Stage 1, setup. After World War II, Bretton Woods established a dollar-centered order where foreign governments could convert dollars to gold at $35 per ounce. The U.S. held enormous gold reserves, massive industrial capacity, and unrivaled geopolitical leverage. Trust was high because the base was real, and the balance sheet looked unbeatable. Stage 2, expansion and overextension. The costs grew. Vietnam, Great Society programs, Cold War commitments, and the natural temptation of reserve currency privilege. Dollars flowed abroad. Claims on U.S. gold rose faster than U.S. gold reserves. Domestically, the U.S. also moved away from circulating silver coinage. By the Coinage Act of 1965, silver was largely removed from dimes and quarters, a quiet acknowledgement that the metal was worth more than the promise stamped on it. The system was stretching again. More claims, thinning base. Stage 3, crisis and loss of control. By the late 1960s and early 1970s, foreign holders questioned convertibility. The London gold pool collapsed in 1968. The pressure built until August 15, 1971. Nixon closed the gold window, ending Bretton Woods convertibility. That was the modern debasement moment, not clipping coins, but breaking the anchor. The 1970s then delivered oil shocks, inflation, and eroding confidence. Policymakers tried controls, Nixon's wage and price controls in 1971. Again, the classic Stage 3 move. Command reality. It didn't work. Stage 4. Inevitable outcome. Hard assets repriced violently. Gold and silver surged through the decade. Silver, in particular, displayed its compressed spring behavior. When monetary credibility cracks, silver can move faster than gold because it is smaller, thinner, and more industrially entangled. The decade ended with Paul Volcker's rate shock beginning in 1979, which reasserted monetary discipline through pain. That, too, is part of the pattern. Stabilization usually arrives only after the crisis has forced political permission for extreme measures. Now, take that same pattern and lay it over the present. No drama, no conspiracy, just structure. Stage 1, setup. The post-2008 world built a new foundation, permanent central bank intervention. Markets were trained to believe that every drawdown would be met with liquidity, facilities, swap lines, and balance sheet expansion. Confidence wasn't rooted in discipline, it was rooted in the put. This created a synthetic stability, a calm engineered by continuous monetary sedation. Check. Stage 2, expansion and overextension. The claim stack exploded. Government deficits normalized, corporate leverage soared, derivatives markets expanded the notional promise universe. Central bank balance sheets became policy tools, and crucially, the financial system multiplied paper claims on commodities, including precious metals, because paper is how you create supply without mining. Verified. Now look at silver specifically. Silver is not just a metal. It is an industrial input for electronics, solar, medical applications, advanced alloys, and modern electrification. That means silver demand is not purely monetary, it's structural. At the same time, silver supply is constrained. New mines take years, ore grades decline, capex is cyclical, and many silver ounces are byproducts of other mining. You can't just turn on silver supply because you feel like it. In other words, the physical layer has inertia, undeniable. Stage 3, crisis and loss of control. This is where the system begins to show you its stress fractures. When inflation returns after years of transitory narratives, central banks face a trap, tighten enough to restore confidence, and you break debt servicing and risk assets. Ease enough to protect the system, and you confirm debasement. That's not opinion, that's arithmetic. Add geopolitical fragmentation, energy insecurity, supply chain reconfiguration, and rising fiscal dominance, where governments require low rates and continuous demand for their debt, and you have the textbook conditions for a credibility crisis. Now zoom in on how credibility crises express themselves in metals. They don't always start with a screaming headline. They start with microsignals. Unusual premiums for physical coins, delivery delays, inventory drawdowns, rising lease rates, spreads that behave strangely, backwardation pressure, and a widening gap between what paper says exists and what can be shipped, assayed, and delivered on time. Stage 3 is where paper markets work hardest to look normal, because the moment they look abnormal, the crowd demands the one thing paper hates: delivery. Check. And here's the most important structural truth for silver holders. Silver is the metal where delivery stress becomes visible fastest, because the market is relatively small, the industrial pull is real, and inventories can be tighter than people assume. Gold is the reserve asset of central banks. It can be mobilized, leased, swapped, and used as a political instrument. Silver is more common, but in a crisis, it becomes more scarce in the one form that matters: deliverable, investable, immediate physical metal. Verified. Stage 4, inevitable outcome, the repricing event. This is when the public stops asking, "What's the silver price?" and starts asking, "Can I get silver at that price?" Those are different questions. One is a quote, the other is a constraint. When enough participants switch questions, the market has to clear at a higher level because the old level was a paper illusion, an equilibrium sustained by the assumption that most people won't stand for delivery at once. Undeniable. This is why your attention matters now. The system does not break all at once. It breaks at the margin. It breaks when the next buyer refuses cash settlement. It breaks when a wholesaler can't source. It breaks when a mint can't lock supply without paying up. It breaks when the spread between paper and physical becomes a social fact instead of a niche observation. And if you want the cold, mathematical reason silver can move violently in stage 4, it's this. Silver sits at the intersection of monetary distrust and industrial necessity. Gold is a pure monetary mirror. Silver is a monetary mirror with a factory attached. When monetary stress rises, gold is bid. When industrial demand rises, silver is bid. When both rise while supply is inert, silver doesn't trend. It re-levels. It leaps to the next clearing price that forces sellers to appear. Now, let's dismiss the comforting myths, because they are the emotional sedatives that get people wiped out in stage 3. This time is different because American exceptionalism. No. Exceptionalism doesn't cancel compounding. A reserve currency is a privilege, and privilege is usually the first thing that breeds overreach. The mechanism doesn't care about your flag. This time is different because technology will save us. Technology can increase productivity, but it cannot repeal balance sheets. It cannot manufacture trust when the issuer is trapped between inflation and insolvency. Technology often accelerates the cycle because it accelerates credit creation and financial complexity. And this time is different because central banks are smarter now. Smarter than Rome, smarter than Weimar, smarter than the architects of Bretton Woods. Every era believes its elites are uniquely sophisticated, and every era discovers the same limit. You cannot print real resources, and you cannot command people to trust a unit that is designed to lose purchasing power. So here's the actionable insight. Practical, not poetic. First, understand what you actually own. If you own physical silver in your possession, you own the physical layer. If you own paper claims, you own a promise that may or may not perform in a delivery stress environment. That doesn't mean all paper is evil. It means you should know which layer you're in before the system forces you to learn the difference at the worst possible moment. Second, think in terms of stages, not headlines. In stage 3, the narrative will whipsaw, soft landing, no landing, recession, pivot, no pivot, crisis contained, new facility, temporary. Your job is to watch the structural signals, deficits, real rates, currency credibility, inventory behavior, and delivery conditions. The story is noise. The mechanism is signal. Third, don't confuse price with availability. In a repricing, the market can show you a number that looks comforting while the real market, premiums, delivery times, wholesale bars, tells you the truth. The truth is always in the physical layer. And finally, do not wait for permission. The system never announces stage 4 in advance because announcing it would trigger it. By the time mainstream consensus agrees that something is wrong, the repricing has already happened, and you are choosing from the leftovers. If you've made it this far, here's the direct warning. The machine is built to protect itself, not you. It will change rules, redefine terms, create new settlement options, and call it stability. But the pattern does not change. When the claim stack overextends, the unit is sacrificed and hard assets reprice. So if you hold silver, if you care about what happens when the paper layer finally has to answer to the physical layer, subscribe now, because the next video is where we go deeper. How the machine was built, how paper metals became a control mechanism, and what happens in the next stage when delivery becomes the only language the market respects. Watch the next one, because the people who survive these cycles aren't the ones with the best predictions. They're the ones who understand the pattern before the crowd feels the consequences.